The most dangerous thing about inherited IRAs right now isn't the stock market, it's the calendar. Because there is a timing trap built into the rules that can quietly strip away a huge portion of what you meant to leave your children without a single warning letter that explains it in plain English. And the IRS knows most families will misunderstand it, delay action, and then get hit with taxes and penalties when it's too late to undo the damage. People keep calling it the 2028 inherited IRA deadline. To be clear, there isn't one single law that says everyone must do something in 2028. But 2028 is shaping up to be the year where delayed decisions collide. Higher tax rates, if current rates aren't extended, compressed withdrawal timelines, missed annual distribution requirements, and penalties that start stacking automatically. If a family waits until 2028 to get serious, they often discover the easy years are gone, and the only options left are the expensive ones. So let's walk through what changed, why so many families still don't understand it, and what needs to happen now if you want your IRA to become an inheritance, not an IRS donation. For decades, inherited traditional IRAs worked in a way that rewarded patience. A child could inherit a parent's IRA and take withdrawals slowly over their own life expectancy, small amounts each year, while the rest stayed invested and growing tax-deferred. Families used this strategy to stretch distributions over 20, 30, sometimes 40-plus years. It wasn't magic, it was simply how the rules were written. The tax bill stayed manageable because the annual withdrawals were relatively small, the account had time to compound. And a parent's retirement savings could become real generational wealth. Then Congress changed the deal. In late 2019, lawmakers passed the Secure Act. One of its biggest changes was the end of the stretch IRA for most non-spouse beneficiaries. Under the Secure Act, most adult children and other non-spouse heirs now fall under a 10-year rule. Instead of stretching an inherited IRA over a lifetime, they generally must empty the account by the end of the 10th year after the year of death. Not 10 years to start, not 10 years to think about it, 10 years to finish. That means every dollar in that inherited traditional IRA becomes taxable ordinary income inside a much shorter window. The stretch IRA didn't disappear for everyone. There are still exceptions for certain eligible designated beneficiaries, including, in general terms, a surviving spouse, a minor child of the original owner with special timing rules once they reach majority, a disabled or chronically ill beneficiary, a beneficiary who is not more than 10 years younger than the original owner. But for the average adult child inheriting a parent's IRA, the old lifetime stretch is gone. Now here's where the situation becomes much more dangerous than people realize. A lot of families heard the 10-year rule and assumed it meant this: fine, we'll just wait until year 10, take it all, and deal with taxes then. That assumption is where the IRS trap begins, because layered on top of the 10-year deadline is another rule that determines whether the beneficiary must take withdrawals in years 1 through 9, not just by year 10. And whether annual withdrawals are required often depends on whether the original IRA owner had reached their required beginning date, meaning they were already required to take RMDs during life and often had already started. The simplest way to say it is this: for many inherited IRAs, you don't just have a 10-year finish line, you have annual checkpoints. And missing a checkpoint can trigger penalties. That is the second rule that turns a manageable tax plan into a financial hit that feels unfair, because most people don't even know the checkpoints exist until the penalties show up. Now let's talk about why this matters right now, not in some distant future. The first wave of beneficiaries under the Secure Act started inheriting under the new rules in 2020. Those accounts have a 10-year window running toward a 2030 end date. That sounds far away until you realize what waiting does to the math. If a beneficiary sits on an inherited IRA for 4 or 5 years without taking distributions, they don't get 4 or 5 extra years. They burn those years. The 10-year clock keeps moving, which means the remaining time has to absorb the whole account. Less time equals bigger withdrawals later. Bigger withdrawals later equals higher tax brackets. Higher tax brackets equals a larger slice of the inheritance going to taxes. And if the account is also subject to annual distribution requirements and the beneficiary misses them, it can get even uglier. There was also a period that confused people badly. The IRS issued relief notices for a few years while regulations were being clarified, and penalties for missed annual distributions were waived in certain situations during that transition. A lot of families misread that relief as a signal that the annual requirement would disappear. It didn't. As regulations were finalized and the relief years ended, the system began moving toward full enforcement. That means beneficiaries who did nothing for years are now discovering that doing nothing wasn't neutral. It was a decision that compresses the tax burden into fewer years and increases the chance of penalties. Now we need to talk about the 2028 part, the reason people are right to feel urgency even though their personal 10-year deadline might be 2030, 2032, 2034, or later. Tax rates. The individual tax brackets established under the Tax Cuts and Jobs Act are scheduled to sunset unless Congress extends them. If rates rise, the cost of withdrawing taxable inherited IRA money rises with them. Even small bracket shifts matter when you're forcing $300,000, $500,000, or $800,000 of ordinary income out of an inherited IRA inside a decade. When someone says 2028 is the danger year, what they usually mean is, by 2028, many beneficiaries will be deep into their 10-year window, and if they waited, they'll have fewer years left, potentially in a higher tax environment and a larger remaining balance, forcing bigger withdrawals at the worst possible time. Let's put it into real numbers. Imagine a parent dies and leaves a $500,000 traditional IRA to an adult child. The child already earns $90,000 a year. Under the 10-year rule, the child has to empty the IRA by the end of year 10. If they spread withdrawals evenly, that's roughly $50,000 per year on top of salary. So instead of $90,000 taxable income, they're now sitting around $140,000 before considering other income, bonuses, spouse income, investment sales, or side business income. At that point, those IRA withdrawals aren't taxed at some special inheritance rate. They're taxed as ordinary income, which means they can push the beneficiary into higher brackets, increase their effective tax rate, and in some cases trigger other phase-outs and higher costs. Even under today's brackets, that can easily produce a six-figure total tax hit over the 10-year period. Now change one behavior. Instead of spreading it out, the beneficiary delays. They take little or nothing for several years, either because they didn't know the rules, didn't want the tax bill, or assumed they could handle it later. Now the math changes. If they burn through 4 to 5 years and still have most of the account left, they don't have 10 years to distribute it, they have 5 or 6. So their annual withdrawal might jump from $50,000 to $90,000 or $100,000 plus dollars per year, depending on market growth and the remaining balance. That pushes them into higher brackets faster. And if tax rates rise in the background, they're paying those higher rates on larger annual withdrawals. That is how a family loses tens of thousands, sometimes much more, simply because they delayed action. Now let's go back to the second rule, the annual withdrawal requirement, because this is where penalties enter and where people can lose money even if the IRA isn't enormous. If the original IRA owner died after reaching the point where they were required to take RMDs during life, many beneficiaries are required to take annual distributions during years 1 through 9 of the 10-year period, in addition to emptying the account by the end of year 10. This is the nuance that destroys families financially because it's not intuitive. Most people hear 10-year rule and assume flexibility, anytime within 10 years. But in many cases, it's not either or, it's both and. Annual distributions and full depletion by year 10. And what happens if a beneficiary misses one of those annual required distributions? There's an excise tax. That excise tax used to be 50%. Under Secure 2.0, it was reduced to 25%, and in certain situations it can be reduced further, often discussed as 10%, if corrected within the allowed window. But here's the real problem. Most families don't correct it because they don't know it happened. They aren't refusing to comply. They're unaware they were required to withdraw anything that year. So the correction window can pass while they're still living under the wrong assumption. Then one day penalties arrive. and now the beneficiary owes income tax because the distribution is still taxable when taken, plus the excise tax penalty on what should have been withdrawn, plus potentially interest and complications depending on timing and enforcement. This is how an inheritance gets cut down before the family even feels like they touched the money. Here's a scenario that illustrates it clearly. A parent dies at 78. The parent had already been taking RMDs for years. The child inherits a $400,000 traditional IRA. The child hears 10-year rule and plans to wait until year 10. But because the parent had already started RMDs, the child was supposed to take annual withdrawals starting in year 1. They didn't. They miss year 1. They miss year 2. They miss year 3. Now they still have to empty the IRA by year 10. But they've also potentially triggered excise tax penalties on multiple years of missed required distributions. Penalties that can run into many thousands, depending on the required amounts. Then add the normal tax bill when they finally take the distributions. Then add the compression problem. Because they delayed, they now have fewer years remaining and bigger withdrawals, pushing them into higher brackets. That's how a $400,000 IRA can turn into an after-tax inheritance that feels shockingly small. And the most painful part is this: it didn't have to happen. If the beneficiary had known from day one that annual withdrawals were required, they could have taken smaller distributions early, avoided penalties, and planned the tax impact across more years. The information exists, but it's not explained in the way normal families can understand. And when rules are complex, the default outcome is predictable. People freeze, delay, and pay more. Now let's talk about the part almost nobody factors in: life events in the beneficiary's life. Inherited IRA distributions don't care what else is happening in your year. If your child is already having a high-income year, sold a property, got a big bonus, spouse had a spike in income, started a business, cashed out stock options, then inherited IRA withdrawals pile on top of that. So a beneficiary earning $150,000 who takes a $75,000 inherited IRA distribution doesn't pay some inheritance tax. They now have $225,000 of taxable income for the year, and that can push large parts of that withdrawal into higher brackets. There is no gentle way to say this. Inherited traditional IRAs can be a tax grenade when they land in the wrong year. Now we arrive at what families can actually do, because the point here isn't panic. The point is planning. If you're a parent with a large traditional IRA and you want your children to keep more of it, the planning window between now and the late 2020s matters. One major tool is Roth conversion planning. A Roth conversion means you voluntarily move money from a traditional IRA to a Roth IRA, paying tax now on the amount converted. After that, the Roth grows tax-free and qualified withdrawals are tax-free. For heirs, the inherited Roth IRA is still generally subject to the 10-year withdrawal window, but the distributions are usually not taxed the way inherited traditional IRA distributions are. So the family trade-off looks like this: pay tax earlier in the parent's bracket, potentially at lower rates, to protect the child from paying later in the child's bracket, potentially at higher rates on top of their salary. The reason this strategy is so powerful in the Secure Act era is because the child no longer has a lifetime stretch. They're forced to take larger distributions within 10 years, which often puts them into higher brackets during their peak earning years. So converting some traditional IRA funds to Roth while the parent is alive can preserve more after-tax value for the family. But Roth conversions have their own traps, and skipping those traps is what separates smart planning from expensive mistakes. First, if you convert too much in 1 year, you can push yourself into higher brackets and overpay tax now. Second, large conversions can increase your modified adjusted gross income and potentially trigger higher Medicare premiums, IRMA surcharges, depending on your income level and the year. That's why conversion planning is usually done in smaller chunks over multiple years, targeted to fill a bracket without spilling into the next one unnecessarily, and with awareness of Medicare premium thresholds. This is not an area to guess. You need someone who can model it, a CPA, enrolled agent, or tax-focused retirement planner who understands Roth conversion strategy, inherited IRA rules, and Medicare income thresholds. Another key decision, beneficiary designations. Most parents name their children directly as IRA beneficiaries. That is simple and often tax efficient compared to trusts. But some families consider naming a trust as beneficiary to protect the inheritance from creditors, lawsuits, divorce, addiction, or reckless spending. This can be useful, but it comes with a major tax warning. Trusts hit the top income tax bracket at extremely low income levels compared to individuals. So if the trust is structured in a way that retains IRA distributions inside the trust, an accumulation trust, the IRA withdrawals can be taxed at high trust rates quickly. That means the same $50,000 distribution that might have been taxed at the beneficiary's 22 to 24% bracket could be taxed at much higher rates inside the trust, depending on trust income and distributions. There are ways to structure trusts to reduce this problem, often discussed as conduit-style structures, but those structures may offer less control than accumulation trusts. It becomes a trade-off. Tax efficiency versus asset protection versus control. There isn't one perfect solution. That's why this needs an estate planning attorney who understands retirement accounts and Secure Act rules, not a generic fill-in-the-blanks plan. Now let's bring everything back to why 2028 is a real warning year. By 2028, many families will be dealing with some combination of fewer years left in a 10-year window because they delayed early withdrawals, potentially higher tax rates if current brackets aren't extended, larger remaining balances forcing larger withdrawals, missed annual distribution requirements turning into penalties, beneficiaries hitting peak earning years making the withdrawals even more expensive. When all those factors converge, families often lose a shocking share of the IRA to tax and penalties, not because the parent didn't save, but because the rules changed and nobody explained the new game clearly. So here's what needs to happen now, practical next steps. If you are a parent over 65 with a traditional IRA, do these 4 things. 1, get a clear inventory. Know the IRA balance, your expected RMD path, your current tax bracket, and your Medicare situation. 2, ask for a multi-year Roth conversion analysis. Not, should I convert, yes, no. A real model. How much to convert each year, how it impacts taxes, and how it impacts Medicare premiums. 3, review your beneficiary designations. If they haven't been reviewed since 2019, they may not reflect today's rules or your current family structure. 4, coordinate the estate plan and the tax plan. A will alone doesn't control an IRA, beneficiary forms do. A trust can protect but can also tax bomb your heirs if structured wrong. If you are a child or beneficiary who inherited a traditional IRA since 2020, do these 3 things immediately. 1, determine whether annual distributions are required. This depends heavily on whether the original owner had already reached the point where RMDs were required. Do not assume. Confirm with the custodian and a qualified tax pro. 2, if you missed a required distribution, correct it fast. The penalty regime is much less forgiving once time passes. Correction can reduce the penalty, but only if done within the allowed period. A tax professional can guide the proper steps, including the relevant excise tax reporting forms and waiver requests if appropriate. 3, build a 10-year withdrawal plan that matches your income. The best schedule is rarely all in year 10. It's usually planned to minimize bracket jumps and avoid stacking distributions on already high income years. One final warning, do not assume your general financial advisor has covered all of this. This topic sits at the intersection of Secure Act inherited IRA rules, IRS regulations and penalty enforcement, ordinary income tax brackets, Roth conversion strategy, Medicare premium thresholds, trust taxation rules. Many advisors understand pieces of it, fewer understand all of it. You need to ask direct questions and demand clear answers. Because the IRS is not going to send your family a simple reminder that says, hey, by the way, you owe an annual distribution this year or we'll penalize you. The deadlines move silently, the penalties are mechanical, and the tax bill is real.